The average American retires at the age of 64, but the life expectancy of that same American is only 77 years old. Most of our lives, we have been taught that when we reach our 60s, that is the time we should retire. That is also when government benefits like Social Security and Medicare begin to take effect, and when we can start withdrawing from our retirement accounts without penalty, since most of them allow withdrawals from age 59 and a half. Imagine for a moment that the societal norm of retiring in our 60s did not exist. If we drew life on a timeline, would it make sense that we work for decades only to have so little time left to truly enjoy retirement? In this content, we will break down step by step how we can retire as early as possible so that we have more years to enjoy the things we truly want to do in life. The first thing we need to understand is how retirement is actually defined in our society. It is not based on your intelligence, your work ethic, or the number of years you have worked. In reality, it all comes down to one thing: money. You can call it wealth, total assets, or whatever you like. But the core point is that we need enough money or assets to fund the rest of our lives while we are no longer working. The amount of money that feels like enough will differ from person to person. It will not be the same as what your friends, family, or strangers on the internet suggest. Everyone's calculations will vary slightly, but in my opinion, it really comes down to answering three key questions. These are your current annual income, your current annual savings, and your current annual expenses. If you know the answers to these three things, you can work backwards to figure out the quickest possible route to financial independence. The biggest factor when it comes to retiring as quickly as possible is your yearly expenses. If you know exactly how much money you are going to spend every single year, especially during retirement, it will guide precisely how much money you need to have invested in order to live off that amount without working. For those who are young or want their money to last forever, financial experts recommend using a 4% safe withdrawal rate. This means you are allowed to spend 4% of your invested portfolio every year indefinitely without running out of money. For example, if you had an investment portfolio of $500,000, you could safely withdraw 4%, or $20,000 every year. If you had $1 million in your portfolio, you could withdraw $40,000 annually, and so on. The idea is that your portfolio will continue to grow enough to cover inflation, any taxes you might pay, and still appreciate even as you make withdrawals. In this way, the amount you spend each year becomes the single most important variable in determining how much you actually need to retire. When it comes to what to invest in to support this indefinite withdrawal, most financial experts suggest broad total stock market index funds. Popular options include VTSAX, which is Vanguard's total stock market index fund, or its FF equivalent VT. Since its inception in 2001, VT has delivered an average annual return of approximately 8.21%. There are detailed resources available that explain exactly how to structure a portfolio for safe long-term withdrawals, and the 4% rule remains the most widely accepted guideline for most people. Assuming we are using the 4% safe withdrawal rate, a simple rule of thumb is to multiply your current annual spending by 25. That gives you the nest egg target you need to reach. For instance, if your yearly spending is $50,000, you would need a nest egg of $125 million to withdraw that amount every year without depleting your savings. This calculation shows clearly why controlling your expenses is so powerful. The second critical variable is your current savings amount and, more importantly, your savings rate. As your savings rate increases, it creates a powerful two-pronged effect. First, a higher savings rate means you are spending less, which directly reduces the size of the nest egg you need. Second, you are able to invest and compound money much faster, reaching your target sooner. The FIRE movement, which stands for Financial Independence Retire Early, is built around this idea. People in this community often save 30%, 50%, or even 70% of their yearly income by living extremely frugally and making short-term sacrifices in order to achieve financial independence much faster. Using a retirement calculator, we can see the dramatic impact of different savings rates. Someone earning $75,000 per year with a 70% savings rate could retire in roughly 8 years. Lowering the savings rate to 50% extends that timeline to about 3 years, while a 20% savings rate stretches it out to 5 years. If we map out a table of savings rates increasing by 5% each step, the number of working years decreases disproportionately. At a 10% savings rate, it takes around 51 years of working to reach retirement. As the rate climbs, the timeline shortens dramatically. At a 65% savings rate, it becomes possible to retire within a decade. What is striking is that the average American saves only about 4-5% of their income. This is exactly why most people must wait until their mid-60s to retire. If you are serious about retiring early, aiming for at least 15%, and ideally much higher, is essential. To make this concrete, let us look at real-world examples based on different spending levels and timelines. Suppose you are currently 30 years old and want to retire in 10 years. At age 40, your current annual spending is $40,000, and you plan to maintain that spending level indefinitely. You already have an average savings balance of around $30,000, which matches the typical savings for Americans under 35. To support $40,000 in annual spending using the 4% rule, you will need at least a $1 million portfolio. To reach that in 10 years with an 8% average return, you would need to invest approximately $63,000 every year. That means your after-tax income must be at least $103,000 per year, which translates to a prax income of roughly $47,000 or more. This requires a 62% savings rate, which is challenging but achievable with strong discipline and high earnings. If you are comfortable extending the timeline to 15 years instead of 10, the requirements become more manageable. You could reach the goal with an after-tax income of about $75,000 and a 46% savings rate. For an even longer but still accelerated path of 20 years, you'd retire with an after-tax income of around $58,000, roughly $82,000 pre-tax, and a more modest 32% savings rate. For someone who is 20 years old today, this path could mean retiring at age 40 instead of waiting until 65 like the average person. These examples illustrate how powerfully your spending level and savings rate dictate how early you can retire. The amount you save each year is a major driver of speed, which is why avoiding lifestyle creep is crucial. Lifestyle creep happens when rising income leads to higher spending on things like luxury cars, frequent expensive vacations, or keeping up with friends. These choices may feel small in the moment, but they can literally cost you years of freedom later in life. The third factor is your current income. Higher income, assuming expenses stay controlled, allows you to reach your FIRE number much faster. This is simply a fact of mathematics. However, you do not necessarily need to switch to a higher paying job or start a side hustle. One creative strategy for people in careers with limited upward mobility, such as teaching, is to make a temporary lateral move to a higher paying location. For example, the average teacher salary in Tennessee is about $53,699 per year. Saving 10% of that income yields roughly $361 annually. If the same teacher moved to Massachusetts, where the average salary is $88,903, saving 10% would generate nearly $880-90 per year, an additional $3,500 or more each year. After accumulating savings for several years in the higher paying area, the person could move back to Tennessee, where the cost of living is significantly lower, and enjoy the benefits of their larger nest egg for the rest of their life. This geographic arbitrage approach can be applied to many professions and industries, though it does require flexibility and the willingness to relocate temporarily. To retire as early as possible, there are 4 must-do actions that everyone should follow. First, clearly define your retirement preferences and remain flexible as they may evolve over time. Decide whether you want to live on $20,000, $40,000, or $60,000 per year in retirement, or whether you prefer to spend freely without constant worry. Set your target early, but reevaluate it every year. You might reach early retirement and realize that full retirement feels too idle, leading you to choose part-time work instead. Second, actively avoid lifestyle creep in any major life decisions that could derail the power of compound growth. This includes avoiding unnecessary luxury purchases like expensive new cars or falling for high-risk get-rich-quick schemes that require large upfront investments. Protecting your ability to compound is essential for reaching financial independence quickly. Third, plan comprehensively, not just for investments but also for relationships and family decisions. On the investment side, carefully consider the gap between your actual early retirement age and the ages at which you can access different retirement accounts without penalties. For instance, while a Roth era allows penalty-free withdrawals at 59.5, retiring at 40 creates a bridge period that must be funded from taxable accounts. Balancing taxable brokerage accounts with tax-advantaged retirement accounts is key. On the personal side, if you are single, have open conversations with a potential partner about whether early retirement is a shared priority. When both partners share the same goals, progress accelerates. If you plan to have children, recognize that raising kids is expensive and will likely extend your working timeline. Planning ahead for these realities helps set realistic expectations. Fourth, keep investment fees as low as possible. Avoid trying to time the market and steer clear of bad debt. Low-cost index funds are the most reliable path for long-term growth. At the end of the day, the purpose of early retirement is to enjoy your life, and that enjoyment can change from day to day or year to year. Staying flexible allows you to live out the many versions of life that may present themselves. Retiring early is neither cheap nor easy, but it is far more achievable than most people realize when you focus on controlling spending, maximizing your savings rate, and increasing income strategically. By understanding these principles and taking consistent action, you can dramatically shorten the time between working years and the years you get to spend doing what you love. The sooner you begin applying these concepts, the more freedom you create for your future,